Hi there, welcome to the Closing Bell on the 1st of October. Today we're going to have a look at the precarious situation we find ourselves in. A couple of weeks ago I sent out a pretty stern warning about how bearish I thought the situation was, and really it's been quite a while that I've been telling you markets were going to sell off. We've been following it pretty closely the whole way down, including the bear market rally, and now the S&P sits on the edge of the precipice, and we have crashing bond markets in the UK and intervention with UK on the edge of starting quantitative tightening next week, and they have panicked, reversed, and started printing money to buy bonds because their bond market was pretty much crashing, and the amount of losses would be mind-boggling through their pension system as those bonds sold off. So this is not a usual situation we find ourselves in. When you start poking around in a market that has been distorted for so long by keeping rates incredibly low, printing money, what is the right price? When things then start to crack, they can move rapidly because you have forced liquidations, and I've been telling you about those things as well lately, but now we are starting to see it take shape. So I just wanted to give you an overview of how precarious the situation is, and have a look at what may be around the corner in this very interesting market. So let's kick off with UK bonds, have a look at what's gone on there. It's nice to look at long-term charts to get a feel for what's happening. This is the UK 30-year government bond yield. So again, when the yield is going down, the price of those bonds is going up. So this is a generation of falling yields, isn't it? Which has inspired rising asset prices. And here we have, rates dropping. They've been sitting around 5% for a long time, dropping down to near zero, just as they did in the US. And you can see, around 22, as rates started rising, that downtrend from the last decade in UK yields has been broken. The long-term trend in yields has turned up. So it started to creep up. There's, selling, pretty steady selling, but look at what's happened just recently. That is forced liquidation going on there, and massive losses across the board in those bonds. As the yield goes up, the price goes down. So what you're seeing there is a pretty slow motion train crash of this trend really turning, and this is what we're looking at in the US. I'll show you the US 10s. But this is a bit further ahead than where the US is, as US dollar rallies, possibly repatriation of money to the US, UK, the bond, the currency really getting hammered. So this is pretty serious stuff, and that's why we've got the intervention coming in around 5% in those 30 years. They've stepped in and said, well, we can't let the bond market crash, and we'll just print as much money as we need, and the rates have fallen over 1% in the blink of an eye. But it's still pretty sketchy, isn't it? And they basically saying they'll be printing until middle of October. So I don't know what will happen then, but I don't know whether that will be enough to turn the tide on what's going on. Crashing government bond markets, that's the real deal. That's the very core of the system. That is quite troubling. And we see that sort of thing in the US bonds, then really watch out. So that's been a pretty interesting development. We've kept our eye on all of these other markets. I wasn't keeping an eye on UK bonds, but look at what happens. It can come out of left field. Once things start to creak, once you've got big moves going on, capital flows worldwide, US dollar going vertical, things can start to break in different areas. And, if we look at just the Italian 10 years, up at 4.64%. So they have really staged a big sell-off, haven't they? Going from 1% to nearly 5%, those 10-year bond yields in Italy, whereas the German bonds are at 2.2%. So we have, part of this monetary union, but their bonds are trading 2.4% above, 100% yield above those German bonds. Does that spread blow out further and create a crisis in the euro? So lots going on, a lot of reasons to be sitting on your hands, and I certainly have been sending out that warning signal to you to be careful. So I hope a few of you have heeded the warning. Would love to hear from you in the comments if you have, and please do, if you have access to the like button in YouTube, to hit that like button for me, because I think Google likes it and ends up spreading my video far and wide a bit more. So that would be helpful if you could do that. So moving on to stocks, we know, let's actually look at the US dollar. And look, I was looking at this a while ago, and you should, if you have been watching these videos, know that my view was that we were going to see a blast off in the US dollar, similar to what we saw back here. You can see we had years and years of really shaking up the Coke bottle in that US dollar, sideways motion, just as we saw here, many years of sideways motion with false breaks of either edge of the range, and eventually the breakout. And again, you saw a similar thing, false breaks of either edge of the range over and over, back to the point of control. And then when it finally breaks out, it's letting the top off that Coke bottle. So it's a similar situation. Where it trends to, who knows? But that US dollar is on a really huge move. It is big news, and it does affect a lot of things. Imagine if you borrowed, if you're an emerging market, you've borrowed money in US dollars, rates are going up and the US dollar's going up. How are you feeling? Can you pay back that money? This is the big story. When currencies are moving, that's huge capital flows. That's the biggest money in the world shifting money around. And, you could see those bonds in the UK. They certainly suffered the brunt of selling. And, what's next, I guess, is the question. And that US dollar has come off with the UK intervention. And you've got to ask yourself, is that then a top? Is that going to be enough? I'm certainly not calling a top here now, but this is just a daily chart. You've got a daily sell pivot. So look, there could be a bit more downside in that US dollar. So if we get a bit more stabilization in the US dollar and US 10 years, perhaps things are going to be okay. But remember, I've been showing you this. Again, I was saying what is going to happen when rates break out above that 3.5% level. That's what I was going on about. So this area that it was trying to hold around that sort of 3 to 3.5% region, that's sort of the highest for over a decade. And, now that it has broken out, it's really got to fall back below that level quite quickly. And then you could say, right, things are going to stabilize again for a while, but that doesn't mean it's not going to end up going higher. But while it's above that sort of region, you've just got to let it do what it needs to do, and it could have could have more selling to come. So it's a pretty interesting time. And just to recap, remember I was saying that it's looking like the end of a generation of falling rates. It's the first time it's really broken out above the lowest high of that downtrend. So here we are, that downtrend now looking under threat. So you don't know where that is going to need to go. Because as I said, it's been government intervention doing this, and now inflation has forced their hand to raise rates, and we don't know where the real price is. And it can be a bit of a panic, because that is a lot of money being lost in those funds. The banks are all full to the eyeballs in these bonds. If you do see a really sharp back up in US government bonds, that is going to be difficult for stocks to ignore, that's for sure. So we are still in a state of we don't know what's coming next. And again, with gold, I was showing you the possible break below 1675, which is the low of the correction of the past few years. So still there's no sign yet of a false break, but it is trying to hold in there. With the UK basically stepping in, printing money, it's showing you that their back's against the wall. They're panicking. Whenever they stop intervening, there's a chance things can crash, so they need to turn around and print. So that means getting on top of inflation is going to be harder and harder, and gold is going to end up being seen as an asset that can help in a situation like that. So this can be setting itself up as a great buying opportunity, and it's just letting this selling play out. Will real rates really back up and get quite high quickly? Will those bonds sell off more, which could see a break below those lows? And then it's just got to find the point when the selling is done and you're waiting for things to turn back around to potentially buy that. The way I'd look at this is I'd be looking at that correction from the last few years, and I'm looking at those levels, aren't I? 25% below and the 618 below. So that's 1580. So, it may only just get to 1580 before having the false break and being a great buy. Or it could get all the way down to 1430 before finding a reversal. So a reversal off there is also potentially the point that you want to be getting long the gold stocks. So that might be a story that's building as central banks have their back against the wall, as stocks crash. They're going to freak out at some point. There's going to be political pressure. Do they end up accepting higher inflation so that they don't crash the markets? So this is going to be an interesting thing to watch. And we've had decades of intervention at every chance. And now with inflation, they can't just easily turn the spigots back on because they will make matters worse. So this is sort of a rock and a hard place for these central banks. Moving on to equities, and this is the S&P 500. I'll be quick with this and finish off. Just need to give you that sense of what's going on. Again, we've been following this, haven't we? The long-term shift in trend, the retest of the long-term moving averages. If it turns back down from there, breaks below those lows, watch out. So here we are at that level, and no one really knows what happens through here. Look, a million things can happen, right? We can have a little sell-off, and maybe it has a false break, and we have a bit of a rally back to the moving averages, and it just takes time. And then eventually we have the big sell-off. So that's, that can happen. You got to allow the possibility of that. That's why I never like selling short at major lows, because you're always at risk of the false break. So where you want to be selling is up here, where I was telling you prices could turn back down from. That's where the risk reward is in entering positions, and it's a very important point, because most amateurs, when it's looking terrible, that's when they want to sell, and often that can be a really bad idea. Just as an example, once it breaks below that low there, what happens? Big false break. Takes all the shorts out. Even there, breaks below, you look good for a while, but then you have a rally, breaks below that low, everyone gets short, and then they all get taken out. So the way you want to trade is you're looking for the false breaks of the high of a range in direction of trend. So once the trend is down, I'm looking to sell there. Once we get the sell pivot, I'm looking to sell there. I've got more intricate calculations, but I can't tell you about. But that's where the opportunities are, because you've just had strength and you're selling as soon as momentum turns back down to join the next leg down. And that's where we're at now. We're at the point when you don't want to be entering shorts, but the big picture is such that this low gives way. It could lead to quite serious selling. So this is a very important point. And look, it might stuff around here for a while. It might look like it's busting, look like it's rallying. It could create a little distribution for a week or two and then finally go when you're not looking, because it never makes it easy. But it is resting on a very serious precipice. Those bonds having broken out. Does the UK actions stop the rot? But just the fact that you're seeing crashing bond markets in major first world countries is something to take notice of. So if we're looking at the S&P 500, we're looking at the whole range since the 2020 crash. It is developing as you'd expect, where it's sort of sold off towards that point of control, finding support. But where is the resistance? The resistance is up in that sell zone area, and it is looking weak. So the question remains, is there much support at all below that point of control? And do we see a quick move? This is what you usually see. Lots of work done in the top half, where there's still buying pressure. Still people think it can turn back up. But then when it breaks down into the bottom half, that's when all those people who were buying and holding on go, oh, get me out of here. And it can be pretty quick, the move to the buy zone. So that's sort of how I see it playing out. And look, it could be great buying down there, but maybe not, depending on what those US bonds are doing and how determined the Fed is still. I'd say they'll be getting a bit scared by the time it gets down there. But it's a pretty classic situation, and it can get so volatile. When you've got a very important point, it can get very volatile and you can get fooled easily. So it's better sometimes to leave it alone when you're in this situation where it could go like this. Look like it's fantastic, look like it's terrible, then have a big squeeze, you think it's going to go up, and then it turns and crashes. And you can lose a lot of money in those periods. So you've got to be very careful what you do. It's basically big picture bearish. There can be more downside. Is the actions by the UK enough to turn this around? Look, it might be for the moment. But if it does bounce off this major level and turn around, you're still looking at it from the point of view of there's a lot of resistance up in near that sell zone, and that we can still ultimately head down there, even if it's in a few months. So that's the overriding theme, is not getting too cocky. It's not quite yet the time to go for it at all. You're just respecting this monthly downtrend, and you're looking back at the last few times it did this, here and here, and you're saying, well, that may be our future, something along those lines. So what is it going to do? And it can get pretty tragic, that move to the downside, and you don't want to be caught and in huge positions and just stressing out at that point, because that's when you'll be dumping it with everyone else, and then you'll see it do this as the Fed starts pumping things up again, probably. So that's how I'm seeing things at the moment. I've been warning you. I'm hoping you've been heeding my warnings, and that you're feeling prepared. And look, it's going to be very interesting to watch, and there will be fabulous opportunities down the track as long as you're still standing. Cheers. I'll come back with more next week.